Hi, you guys. My name's Hans Olson. I'm one of our senior sales executives here at Avalara. I've been with Avalara for about 8 years. I've managed a variety of our spaces, and my responsibility is to understand our clients' requirements, make sure we're a good fit for them, and really just have a good understanding of sales and use tax throughout the United States. So today we're going to talk about building a rock-solid sales tax strategy. Next slide. All right, so for the agenda today, we're going to talk about a few items. First one is why sales tax matters. Next is when to collect. How do you know if you have nexus, i.e. the requirement to register, collect, and remit? We'll talk a little bit about industries with the highest compliance risk, the 5 W's of sales tax automation, and next steps. All right, so first one, why sales tax matters. Sales tax is a state-by-state tax. It's not federal. Each state dictates their own rules, whether that's boundary lines, as well as product service taxability. A large percentage of the revenue for each state is generated by sales tax. One chart I'd like to show you is up here in the upper right-hand corner, and there's a reason we did this for 2010. Obviously, since 2010, there's been a lot more e-commerce that has been going on, and the rules have changed regarding where companies have to collect. A lot more customers or clients or companies that sell through e-commerce have a requirement to collect regardless of physical presence. And so we've seen a significant increase even from the 24% back in 2010. Okay, so the impact of COVID-19. Very similar to what we saw in 2008, 2009, when we had the mortgage-backed security issues. What we found were states at that point were being lenient. After the time period when things started getting back onto track, those states started hiring a lot more auditors. Those auditors that they hired were actually located outside the state that was hiring them to catch businesses that were conducting business, should be registered, and were not. The reason we bring this up is obviously during COVID times, a lot of us are stuck at home right now. While states are leaning in the meantime, in the long run, it's not unfair to think that they're going to have to recoup these losses. If we go back to the previous slide, a lot of that revenue is coming from the states. And so it's really important for businesses to be on top of this. What are your requirements? So where do you need to register? What are the rules in that state, whether that's the rate allocation or what's taxable or not, and obviously the filing and remitting process. So, good fun fact down here, states are expected to run a $290 billion deficit in 2021. So. All right, so how do states respond to budget reductions? States prioritize efforts to recoup losses in a couple ways. One, they'll increase sales and use tax audits. We talked a little bit about that. Essentially what happens is an auditor walks in and they determine you had a requirement to register, collect, and remit. They'll take a sample size of those invoices, see what should have been applied, and then extrapolate that over the time period, or we call the look back based on when they had created that requirement to collect. Next is a crackdown on economic nexus laws. We're going to get into this a little bit more down the line. But essentially what that is regardless of physical presence, if a company hits certain thresholds, whether it's economic, so dollar amount, or transaction amounts during a trailing 12-month period, they have an obligation or right to enforce, the states have a right to enforce economic nexus laws, i.e. that company needs to be registered and collecting and remitting. In addition to that, states are starting to tax products that historically haven't been taxable. So, for example, digital goods and services. We look at a company like Avalara, a large portion of our business is software as a service. A state like Washington, which is where I'm located, we tax it. California doesn't. Texas taxes it at 80%. Over the last few years, we've seen a dramatic increase in states that have started to tax digital goods and services, something that is a non-tangible item. The other way they can do this is through a rate increase. In the U.S. alone, there's about 13,000 different tax, 13 to 14,000 different tax jurisdictions. They do change over time. And about 20% of the rates and rules change annually. And so to recoup some of those losses, states do increase taxes or add additional taxes in the composite rate. It's important to know what those are and keep them up to date as you need to apply the appropriate rules based off that day's legislation. Okay, so let's talk a little bit about nexus, i.e. when to collect, where do you have a requirement? So when must businesses collect sales tax? Sales tax nexus defines the level of connection between a taxing jurisdiction, i.e. the state, or a locality in certain states, and an entity, i.e. the business. There's a few ways that you can create nexus in a state. Historically, as of a couple years ago, the classical definition of nexus was physical presence. So that could be people, place, property, unsold inventory, subcontractors that maybe you're invoicing for the service of those subcontractors. Any kind of physical link would create that requirement to register. As of a couple years ago, on top of physical nexus, the Supreme Court ruled in favor of South Dakota against the large marketplace Wayfair. And what that did was give the states rights to enforce economic nexus. So if you don't have physical presence and you reach a certain state-defined dollar amount or transaction amount over a period of time, you have a requirement to register, collect, and remit regardless of physical activity. Other ways, these fit more on kind of the attributional side, i.e. states decide this state by state, is one's click-through nexus. So seller meets sales threshold in a state from activities of an in-state referral agent. Affiliate nexus can create this. This is a remote retailer holds substantial interest, is owned by an in-state retailer that sells the same or similar line of products under the same or similar name. The last one we see here, the fifth, is marketplace nexus. Recently, there have been rules called marketplace facilitator rules that put the responsibility of collecting tax onto the marketplace. So, you think about that naming names, think about the big marketplaces out there. If you have a substantial amount of businesses or orders coming in from certain states, you have a requirement not only to collect it for that order, but all orders within that state, collect it as a marketplace, and then remit on behalf of your vendors. And here's just a list of nexus generating or creating activities. We see multi-state locations, that's physical presence, maintenance, service, repairs, anything that you're invoicing for, whether it's a service and you got people there, that's going to create that physical link. Owning and leasing property, hosted data centers, a variety of different things that can create that requirement. One thing to note on this as well is there are a lot of rules that are consistent from state to state. There are certain things that states do deal with differently. For example, trade shows. On one side of the pendulum, you have some states that you can spend as much time as you need as long as you're not exchanging inventory at that trade show, and they don't consider it presence. They consider it extensive marketing. On the other side of the pendulum, some states will say if you spend more than 48 hours there, even if you're not exchanging any inventory or you're not doing any services that you're invoicing for, they would consider that a nexus generating event. So important things to look out for. In 2020, 2021, we're still going through it. A lot of companies have allowed their employees to work from home. Those remote employees, they're working out of their house. That also creates nexus. All right. We talked a little bit about this. What this state is, or this slide states, is simply kind of how the rules have changed. So South Dakota versus Wayfair, has enforced economic threshold rules. No longer is physical presence the standard for having to register and collect. The original ruling, Quill Court versus North Dakota, is still in play. So if you have physical presence, you do need to register, but it adds an additional layer, which is that sales threshold. So as of right now, we have 44 of the 45 states that collect have adopted rules. It's actually 45 of the 45 have. The one state that was left off of this is just looking, we're waiting for the effective date. Okay, so this gives some context on the rules from state to state. There is some consistency in this. What we're seeing from a dollar amount is anywhere from $100,000 in a state like North Dakota, all the way up to $500,000 in states like California or Texas. Some states count exempt sales, others don't. Others put quantity amounts. So if maybe I have a lower average sales price, but if I'm doing over 200 invoices or what we call transactions within that state within a year, that state would say you have a requirement to register, collect, and remit. The gray states that you see here, they don't have sales tax. All right, so let's talk a little bit about industries with the highest compliance risk. When we talk about compliance risk, there's different ways that a company needs to stay compliant depending on what they're doing. Retail is the most common. You're selling a tangible item, you're selling it to a consumer or what we call the end user, the person who's consuming the product. The responsibility of that business is to, one, determine where they have a requirement, so physical presence, economic thresholds, and then apply the appropriate sourcing rules or tax calculations behind their invoices. A lot of states you're required to collect based off the destination, so where you're shipping a product or the title is transferred. Others, like Illinois or Missouri, if you're sending within a state line or what we call an intrastate transaction, it reverts back to the origin rate. Other states like California or Texas can have mixed sourcing. We're actually pulling rates from both the origin and destination. Now, each state, again, makes their own rules, so it's important to stay up to date with these. You have to know what they're applying, not only based off the location or the sourcing rules, but also the product or service that you're selling. Next we have here is technology companies. For example, software products, software as a service, digital goods. States tax these different. So for a company to be compliant, obviously they need to know where they have nexus. They have to know how that state dictates their product or service or defines it, and then how they tax it. You then need to apply the appropriate rate based on where you're selling that product or where it's consumed. Some difficulties with this is maybe you're selling 100 users for your software. You know the locations of those different users, and you need to accrue tax based on where those users are located, which can have a different rate or rule. So the third one is manufacturing or distribution. This is a segment that doesn't get talked about a lot during sales and use tax, but it should be. And the reason of that is typically manufacturers or distribution companies, they're selling through resellers. It's still the responsibility of the manufacturer to collect exemption certificates. Again, a company has the obligation to collect tax unless they can prove why they didn't. And those state issue documents, the resale certificates or exemption certificates, are their proof of why they didn't. They have a responsibility to collect, track, and manage these exemption certificates. Certain states, these expire as well. So if we look at a state like Florida, resale certificates expire annually. One other thing that's important on here, we always talk about sales tax. Use tax is really important. When a company purchases something for use of that company, they're either going to get charged sales tax, or if they're not, they're going to have to accrue use tax, which is self-imposed tax. But they would need to look at where they're consuming the product, what are they consuming, and how the state dictated rules behind those products. So that information gets consolidated with the sales tax return, and that's what they're filing on. All right, so let's talk a little bit about the 5 W's of sales tax automation. The first is, what is sales tax automation? In essence, it's automating end-to-end sales tax processes for greater efficiency and improved accuracy. The way that we do it is we have a cloud-based software that integrates directly with our accounting system, so ERP, could be a point of sale system, e-commerce. Anytime a calculation is needed, it makes a call to us. We're calculating based off that day's rules. So rooftop accuracy, product service taxability, and the appropriate rate allocation. All those calculations happen in about 60 milliseconds. Then a subtotal of tax comes back in into the document. That way they can collect it from the customers. Now, once you've calculated the appropriate tax, all that data is collected into an online portal. You have to be able to consolidate it, give a second source of reporting, fully broken out by the requirements of each state. That could be state, county, city, special tax, RTD taxes. From there, they put you on a filing calendar. So you have to be able to remit and show what you're remitting back based on that unique filing arrangement with the state. That filing arrangement, that could be annually, quarterly, monthly, biannually in some states. Some even have prepayment. So California, it's very common to have a monthly 90% prepayment and a quarterly return that accrues that additional 10%. So the big value add of having a cloud-based software is you no longer receive any, file updates, rate changes, rule changes. By having a central depository of updated rates and rules and making a call out to that, anytime a calculation occurs, it's going to give you what needs to be applied based on that day with the logic to back it. All right, so next is who needs sales tax automation. We talked a little bit about the industries, specific industries, but really it's everybody. What that should say is sales and use tax. Because at the end of the day, you have a responsibility to collect tax. If your customer isn't taxable, you still need to collect exemption certificates. You need to, store those, track them, make sure they're up to date and accurate. If you don't charge sales tax and you have the exemption certificates, almost every company makes purchases for the consumption of their company or of their company, i.e. use tax. You need to be able to apply the right rate of what you're purchasing and whether or not that product is taxable or not. All right. One of my favorite, why automate sales tax? Long story short, it's extremely difficult to do this manually. Sales tax for a company is a very high turnover business. A lot of people are moving up or moving out. Not only if you have someone located in there, but it's very difficult to maintain the rates and the rules behind what you're doing. Let's say you have nexus in every state. You need to maintain taxability matrices. You need to maintain rate tables. Usually, if they're doing it manually, they would be using a rate table, so zip code. The problem with zip codes were made for shipping purposes. While they're okay, they don't always correlate with the right tax jurisdiction line, i.e. two customers right across the street from one another, same exact zip code, completely different tax rate. And so with our solution, what we do is we validate the address. We scrub it against the U.S. Postal Service database. In the back end, we convert it to lat long coordinates. So they always have rooftop accuracy with the calculations. But according to a 2017 survey, you can read it here as well, but companies have on average 6 people dedicated to sales and use tax management. That's up from 4 in 2014. And that, again, high turnover position in the company. They devote an average of 39 hours per month on tax compliance related tasks. Nearly half of the respondents still look up tax rates on states' websites. We've actually had occasions, believe it or not, because we have direct relationships with the states, where we've got an update before they've actually updated it onto their website. So, as well as if anybody calls into a state, you don't know exactly who you're talking to and if you're getting proper information for it. So the last point here, 43% of companies use a filing cabinet or other hard storage to collect, validate, and store exemption certificates. When you do that, you still need to track it. Just because you have a copy doesn't mean that copy is going to be valid indefinitely. You need to be able to track those, make sure you know expiration date, ID format, the signature, be able to validate. Yeah, those are your proof in the case of an audit of why you charge sales tax. Okay, just pretty self-explanatory side, why automate sales tax, just continued accuracy. By using this, an automated sales tax tool, you can get rooftop accurate. It's efficient. You no longer have to spend time managing rate tables, taxability matrices. You no longer have to do any filing. You don't have to break out reporting. Customer satisfaction, streamlined taxation or transactions of instant sales tax calculations. It's a very fast product. It's an accurate product. No longer will, if you did something wrong by doing this manually, will you have to go back and try to either recoup or readjust the amount of tax you collected previously from a customer. Next is risk management. With accurate results, you decrease your company's risk. And then business growth. The less money you have being allocated towards something that's not bringing in revenue, i.e. tax compliance, the more you're able to free those resources up to high value revenue generating projects. Okay, so when should you pursue automation? I'd argue right now for any company, but obviously there are trigger events for this. Every company has their requirements. Some of them though are maybe the head of a financial event, IPO, a funding round, a merger, an acquisition, some kind of financial event that you need to make sure everything's buttoned up and cleaned. Next is pending company growth events. Maybe you're launching a new product, expansion, creating new divisions. Particularly around launching new products. If it's a new product line, most likely it is taxed differently than your previous product line. And so it's important to know what that is so you don't get in trouble down the line with it. Leadership and technology shifts. Maybe you have a new CFO, you're updating your technology platform. With Avalara, we have about 1,000 different pre-built integrations, ERP, point of sale, e-commerce. A lot of companies will start using us or communicating with us when they're making that upgrade process to a new platform. That way, while they're doing testing, they can get a solution in, and that way when they're live, they're fully up and running for sales and use tax. The last one, and this happens quite often, unfortunately, is after a sales tax audit. Companies wait on it, they get audited, and they find major exposure during an audit. They know they have to clean things up. Always it's better to get ahead of the ball. Tax is not something that disappears, it just expands. Certain states have, for example, penalty rates of 50% year over year. Some have unlimited look-back periods, others have 8-year look-back periods. So automating sales tax is really about protecting the company's wealth and limiting the amount of exposure and risk down the line for them. Why pursue automation now? In the midst of COVID, we talked about this a little bit. Sales tax is the last thing businesses need to worry about. Automation reduces this burden. In addition to calculating tax, we also have the ability to track economic thresholds. So anytime a client of ours logs into their homepage, there's a big heat map of the US. They get to 80% of a limit within that state turns light orange. 100% turns dark orange. We're giving them the information so they can make those executive decisions to be in compliance with the states, not only after, but before the fact, so they can start from day one. The other sales tax changes, our rules change rapidly. We can expect rates to go up as well. As we've said before, states are in a burden right now. They have major deficits. They need to recoup this somehow. And so being able to keep those up to date live, having a solution in place to maintain the rates, the rules, really does help with that. Okay, so the last is how to choose the right tax automation solution. We can talk about good solutions, calculations, certificate management, returns management, dynamic reporting capabilities. What a great solution does, though, is prioritize innovation and product delivery. We've historically had more integrations, not only historically, but now as well, more integrations than any other provider out there. We're trying to be part of every single transaction in the world. In order to do that, we have to prioritize innovation and continue to build those integrations. Have the ability to grow with your business as you expand. Not only our pricing model allows this, but by us integrating with pretty much everything out there, it allows those companies who are current customers to migrate or evolve to different solutions and know that they have the same solution in place, continuing with that. The other with that regarding products, we've talked a lot about the US, but this is internationally. A lot of changes going on right now. If we look, for example, at the UK with Brexit, a lot of rules, rates that have changed. Avalara has the ability not only for US, North America, but international as well. Okay, so where to start? Another one of the W's. You need to reassess tax obligations by determining where you have nexus. We've gone through it, so I'm going to go into too much detail, but know your physical presence. It's really important. Of that, remote employees is the one we're seeing the most right now. Economic nexus, know the state's thresholds. Know where you have significant economic presence. Most likely, if you have, and you've had for a couple of years, you've reached a threshold, which means you have exposure. That's not to scare anybody. It's more just it doesn't have to be an issue. You can do something about it. There's a lot of programs out there to help it as well. So, next is affiliate nexus, and then as well as click-through nexus, which we discussed. So, with Avatax, within Avatax as well as Avalara alone, we do provide sales tax risk assessments. You can tell us your economic, your presence. You can tell us, give us your transactional data. We can tell you whether or not you have an obligation in the state to register, collect, and remit moving forward. All right. One of the best programs out there right now. So you'll see free sales tax services for qualifying businesses. When you see this, this is what we call the SST. It's an acronym for the Streamlined Sales Tax Organization. We are one of the only providers that are certified for them. And what the SST is it's 24 states that have bound together to simplify sales tax. If you use a provider, certified provider, you get registrations at no cost, all of the calculations and all of the filings at zero cost. Essentially, the states pay us directly for that. Most importantly, there are uniform definitions and rules throughout these states, which means if you use Avalara within these states under the SST program, you're essentially safeguarded in the case of an audit. So, all right, this is just kind of a diagram of what we do and some of the products that we manage. First is calculations. How do you collect the appropriate tax, not only based off locations, but also of what you're selling? Returns. So how do you get that information? How do you file it? How do you make sure those returns are filled up properly? Documents. So exemption certificates, resale certificates, being able to maintain those documents and keep them up to date and accurate is really important. Next is registrations. We are able to, through our tax advisory and registrations team, business licenses team, we can get you registered in states, whether that's individually, multi-state, or with our SST program. All of that is available. Next is payments. So not only do we have the ability to calculate and file, but we also remit directly on the behalf of our customers to states. So we pull the amount of tax they've collected and are able to distribute that. So it's a touchless contact with the state for the filing and remitting based on that unique filing calendar. Lastly, here is insights. We have Avalara University. We have a recent acquisition from TTR in which we've substantially increased our content. We have the ability to give you insights of what's going on, what's most likely going to happen, as well as keep you up to date with any rates, rules, anything regarding transactional tax. All right, here's a few as well as insights. Avalara's COVID-19 Resource Hub. You can see all the latest news and insights to navigate an economy in flux. Laws by state, sales tax nexus. You can explore which states currently enforce economic laws. We also have on our website all of the different thresholds for each state. Avalara Commerce Monitor. You can learn national trends and insights from Avalara data regarding manufacturing, retail, and services. And then obviously the last piece is our solution. It's sales tax automation, the ability to calculate, the ability to full reporting, to file and remit, and manage and secure those exemption certificates so you're compliant from a sales and use tax perspective. Okay. So I hope you enjoyed our preview. I know we talked about a lot of stuff today. Obviously, we're going to have this recording. If there are any questions, please let us know. We're here to help. We don't expect you guys to be sales and use tax experts at what we're here for, and we're more than happy to get anything addressed for you. So thank you for the time, and we're looking forward to talking with you.